a few equations today. I think if you are afraid of equations, I will not solve the model. Okay, I will not try and solve the model because that will be too much. But we didn't receive all the time, but I'll try and give you some intuitions, some key equations from where we can derive some. So the point is basically to understand the intuitions what's going on. So, but before going that, what I would like to do, what we had discussed yesterday about the new trade theory, that new trade theory thinks about that farms are heterogeneous. New trade theory thinks about that farms have different set of marginal costs. There are other stylized facts from which actually new theory or the trade theory or the IO or development, the new development theory originates, which we look for farms, how farms in the economy, because why do we care for the farms for the economy? Because ultimately, what we taught in HO said to us that countries do trade. Right? Countries have comparative advantage, countries have absolute advantage, countries have more labor endowment, countries have more capital intensive, but eventually, if you say the countries don't do trade, it's actually the companies that do trade. That's what the new international trade theory says, that it's the farms or the companies that actually send goods outside. It's not the country. It's reported by the country, but when you go down to the customs data, you will see different companies that are sending goods. When you're buying imported goods, it's not the country per se is importing goods, it's the different companies are buying goods from foreign and selling it to you. So it's actually the farms, in academics we call it farms, not companies. With the farms is actually involved in international trade. They are importing, they are exporting, even in terms of employment, capital. It's not the country per se capital intensive. It's the farm which is capital intensive or not. How much of capital are employed in the production function, that's what makes capital intensive. How much of employment I'm using, it's country. At the macro level, it's the country per se. Let's say India produces labor intensive goods, and the US produces capital intensive goods. But why US is capital intensive and India is labor intensive? Because the farms uses production technology which are more labor intensive. It's not the country first. It's absolutely at the end, at the macro level, when you think at the geo-equilibrium picture, it's a country, but it's actually the farms at the micro level that adds up to the macro. Right? That's what. So that's why we care at the most micro level. The more micro level we go, the policy is better to understand. Because some policy-wise, when we act, what we do, because we care about at the end of the day, we want to give policy. Though academics are very bad in terms of giving policy recommendations, there are very few academics who actually are very smart enough to understand both policy simultaneously and academics. And they're not me. Believe me, they're really not me. We do say they need to understand equally well which policy would work and which not, because we do, at the end of the day, we do think about policy, but policy does not drive our research per se. So, how development economics is related to farms? Because farms about wait, that's what I'm coming. The next one is labor. Labor is labor market changes is done by farms. How many or what is the share of your supervisory worker? What is the share of non-production worker? What is the share of production workers being employed? Is labor market changes driven by micro firms? You see it at the macro level. Innovation drives by farms, not by countries. The innovation that is undertaken by the farms. That's why development is so related to farms now. Because if you have to understand innovation, you have to go at the farm level. Is the farms a patented farm or a non-patented farm? Because innovation drives, we all know innovation drives growth, right? So what kind of innovation then? Is the farms related to process innovation? Is the farms to product innovation? So all this to understand, you have to really go down to the farm, the company level to understand which type of innovation a farm is engaged. There are others as well. There are many others, finance per se. how finance drives development, we all know. But how this finance, then you have to look at the banks. How banks is doing the finance. What are the farms which are actually, it's not the country per se, the banks are actually doing the finance. You have to come down at the micro level to understand that, and then we can understand the policies really. Because you will see in the recent times, I don't know how much you follow the financial sector, there's a lot of policy, especially after Raghuram Rajan came as a governor, who is one of the very few persons in the world who understand policy as well as academics. Like that's smart enough. Generally, people don't that smart enough, like Raghuram Rajan. So there are a lot of banking policies actually came out, if you don't know or not, to correct for the banks underperformance, to pay, or not only banks underperformance, one of them, but to also take out zombie farms. A lot of farms are called zombie. You know, these farms don't operate efficiently. Just be there, producing some goods or not, taking a lot of money from the bank is actually a major source of misallocation in our economy. So when you are taking policies, we need to see at the micro level to understand how this, because some sectors maybe doesn't need that policy. Some sectors have more zombie farms or inefficient farms. Then you as a manufacturing sector, it would be inefficient to take a policy as a manufacturing sector. Then let's say the leather sector takes a policy to tease out the zombie farms because the proportion of zombie farms or inefficient farms are higher in that sector. Right? So even if, so that's why we look more at the farm level to understand what farms do. And let's see what actually does. That led to the new trade theory. There are many facts. So what we'll do, we'll review some very recent evidence through some simple tables using microdata in the last decade across the world, which has actually motivated the new trade theories. But these theories are still difficult to confront with a number of recent facts. We cannot always write theory on everything. It's very difficult because when we write theories, we have to solve in a general equilibrium setting. It's always not possible to solve in a general equilibrium setting. In fact, Melitz model, we'll see today in a little bit more detail, was difficult until and unless people. So if you see the Melitz model, actually the Melitz paper, there was not an analytical solution. When Pareto distribution was assumed, then there was an analytical solution. So it's very difficult to close the model always in a general equilibrium setting. Because general equilibrium setting, everything is moving continuously, right? It's not a partial equilibrium approach. When you move everything, relax all the assumptions, then it's very difficult to come to an equilibrium. That's the problem. So the first one was producer heterogeneity and excess reallocation. There's a vast heterogeneity across plants, farms, in productivity, capital, and skill intensity. Heterogeneity is also within industry is often large as across industries. What do I mean? Is we as economists, we always understood, it's not about trade economics. As an economist, we understood that leather industry is very different from truck producing industry. Or truck producing industry is very different from pharmaceutical industry. But what the data showed us that farms, even within truck industry, even within pharmaceutical industries, even operating in the same industry are very different. So why that is the case? That was one of the facts that came out from the data. Entry, exit, job destruction, and reallocation in all industry even absent of any large-scale reforms. There you will find a lot of entry and exit. Even there was no policy change, you will see a lot of entry, exit of firms happening, a lot of job destruction is happening. And also, obviously, after trade liberalization, most reallocation that we see in terms of resources happens within industry, like resources flow from one farm to other or some set of farms to other set of farms. Because some farms exit the industry, some farms when there is a shock inherent, any kind of shock, any kind of policy changes, inherent inequal in nature. If you have an international trade shock, you cannot find out any shock which is equal by construction. It cannot happen. It will affect differentially different set of farms. By construction, any shock is like that. If it's a policy change, if it's an international trade shock, any kind of financial crisis. So you can imagine what the financial crisis shock You can imagine many other kinds of shocks in the recent times. That is affect different firms differently. Some firms exit from the market, some firms gain from the policy changes, and then there is a reallocation of resources. What I mean by reallocation of resources is when some firms are exit from the market. Let's say I am a labor working in a firm which exits from the market. I now go and find a job which is actually gaining from that policy. So that's for reallocation of resources. That will happen also for the capital. Capital will also move from one way. Let's say if capital finance, for example, think of finance. I was borrowing from the bank, I'm exiting the market, there's a bit of money left for the banker. So the part of the firm which is gaining can grab that amount of money. The firms which are gaining there. That's what we call the reallocation of resources from one firms to the other set of firms. Because some firms are tying out in the process. Right? So you can see this is plant level productivity within industry. The standard deviation of productivity, even within the same 4-digit industry. You know, we classify industries by 2, 4, 6, right? 4, 6 is very, very disaggregated. 4 is the most disaggregated we generally use in the world data when we talk about industry, not product. Product, we go more at the 6-digit level. When we have within productivity industry, within 4-digit industry, let's say an IC, if you know the IC codes, for example, if you let's say an IC 1511, which produces, I don't know, food products which can be stored for long. For example, even within that industries, you can see the standard deviation of productivity of farms is 66%. It's huge. Even within industries, there's a huge standard deviation in terms of how farms produce goods. And it's for the US. This is for the US data set, manufacturing of plants. Even within the exporters, you can see this is exporter versus non-exporter. There's a 15% difference. This is huge. This is unconditional when we're conditioning. And the productivity measured is the value added divided by the number of workers. Value added is sales minus raw materials. That's the standard definition of value added. So you can see huge, whatever we do, even within the same capital intensity, this is the farms which use similar set of capital intensity, the variability is 67%. This is a huge difference. Even in the production labor share, it's about 73%. So there is, so these came out and people start thinking that why is such the case? Why even within the industries, farms are so different? It's not only across, it's the truck producing farm is different from shoe producing farm, I know, or shirt producing farm, I know, or a medicine tablet producing farm. But even truck producing farms are also very different. The productivity of the truck producing farms or the productivity of the shoe producing farms are also very different. Even different when they are within the similar capital intensity rates. That means productivity, the way we produce stuff are very different. The way we use capital, the way we use labor are very, very different. So what is BINS? BINS is basically like a, so let's say capital intensity BINS means I have taken this upper 75th percentile bin, like that. Like similar bins, like if I am in the distribution, I'm in the 90th percentile bin, 80th percentile bin, something like this. This is standard deviation is across those bins. So this is farm entry and exit. Yes, sorry. Absolutely.
On the previous slide, you said some firms gain and some firms lose, so that they exit the market. Is there any specific trend behind, like who are losing and who are gaining? Are they following a particular trend or process in this?
Process is very difficult to know, but we know which farms, that's the next slide actually, which farms are losing out most in the industry is the next slide. Just hold on to the thought for a minute.
So basically, my question is how they are gaining, how they are losing.
So the gaining is in terms of the market share. Let's say there are 5 farms in an industry, okay, and we used to sell 100 rupees of goods by 5 farms. The top farm for example, sells goods of 50 rupees. The second farm for 30 rupees. The next farm for 10 rupees. For the next 10, what happens? 60, 20, 80. Sorry, next 10, next 5, next 5. So 60, 20, 10, 5, 5, for example. That's the market share. Now, there is a change that happened, a trade liberalization process or a policy change or whatever happens, or over the simple trade if you take, what happens is the smallest two farms, which are selling 5 and 5 rupees of goods, will die out in the market. That 10 share will reallocate to the biggest of the firms, which is selling. Because there's a market. If you think about still the market share is constant, market access or market size increases. Even if you put away this assumption, if you think market size remains constant, even that what is that gap would fill that gap of 10 rupees of goods, because this would go back, because I am, as a big farm, would see there is a gap of selling the goods. There's an excess demand that creates the goods. Would I sell? It goes back to the big, generally, the trend which we have seen is the biggest firm capture the market share more. The biggest firms grow more when there is any kind of reallocation. That's what we mean by reallocation. When the market share reallocates to the biggest of the firms, because the biggest of the firms are expanding the production. For example, the firm which is selling 60 rupees of good is now selling 70 rupees of goods. For example, the 5-5, okay. The problem is now you are selling 70, but you have to expand your production. To expand your production, what do? You have more capital, you have more labor. So what let's say two people who are working in those two farms, which are selling 5 worth of goods, and now started working in that farm, which are selling 60, used to sell 60, now 70 worth of goods. So that's called the reallocation within the industry. And that's what we have seen more or less across countries, across any policy change, that there is a reallocation that happens even within each industry. Across industries, we know, even within each industry.
So, do we know about any specific factor behind this particular process?
The factor is the Darwinian theory.
Gaining and smaller firms.
That's the simply Darwinian. If you think about Darwinian theory, is exactly Darwinian the method of exactly the probability of survival. I cannot survive when there's policy change, when there's a competition, market competition increases, some firms don't survive. It's exactly Darwinian process. And some firms survive better, because some firms can survive competition better, some firms don't survive competition. It's the same with humans as well. Some we as person, some people survive competition, some people don't survive competition. It's exactly the same process. It's because I am not efficient to survive that competition. That's why firms don't survive. And it's better. So if you think about theoretically, it's in a better way to think about the small inefficient firms should die out, because they are not using capital and labor efficiently to produce output. Better efficient firms, so the high productive firms are efficiently producing output. So one who cannot efficient, they should close down and do other stuff which they are efficient about. So one of the biggest, let's say, real misallocation problem in Indian industry, I think you can relate to this, that's why I'm giving the example, is the exit process. So they don't let firms die out. If you go to the Ministry of Corporate Affairs data set, you will see that firms don't die out. It's very difficult to exit the market in Indian sector. It used to be very difficult to entry. If you know about this, it's with the trade liberalization, we did a process called delicensing, where we delicensed industries before 1990 or before 1991. A firm to open a plant had to take 38 signatures across different government departments to open its operations. 38. So can you imagine? You will not be. So that kind of went out with the delicensing policy, with the trade liberalization policy. We made firms as free entry in the market. But the problem is the exit. Exit also affects, because you need churning in the market. The churning, it doesn't happen, it creates a misallocation problem in the market. because you are not using resources efficiently. You are not using that land efficiently because you are not producing output efficiently. That's the problem. So it's basically simple Darwinian process. Okay. So here you can see if this is the entry or exit rates. So when we have the smallest farms, you can see the smallest farms. This is the overall entry rates. When we delete the smallest farms, the entry rate is not very different from the smallest farms. Entry is very less. That's the point. And you can see the entry rates actually increased over time a bit. It got stuck in the 1970s. When we do the exit rates, yes. It's like the money hasn't judged the market. When a farm starts its operations. So like if it happens might be small in that sense. It could be. No, not every farm is not small in the sense. You have a more paid up capital. Many big firms start with a paid up capital. Yeah, absolutely. No, you don't start as, let's say, the biggest startup. You don't start like that. But there is also a distribution of capital. There is a distribution of, let's say, we're below 110 lakh, I think 1 million, you'll be classified as a small farm in plant and machinery. 10 to 50, I'm pretty much sure 10 to 50 is the middle, small and medium scale enterprises. Above 50 lakhs or 5 million is the biggest firm, or above 1 crore is the biggest firm, some big farm, something like this. There is also a distribution in that. It's not like you have to start with the capital which Tata has. It's impossible to start with because you build up for generations with this capital, right? So now to calculate this entry rate, what is the denominator? Oh, the entry rate is the new farm starting its operation divided by the total number of farms existed in the industry. That's the entry. So if you see, let's say you are observing farms over time, you suddenly see a new farm joining. So you get a 1, that farm, divided by the total number of farms in that industry. You can see the entry rate is about 41%. This is also US data. Exit rate is also very high. You see, all farms, you can see the exit rate is also very high here. 41% is exit rate, 50% is exit rate above. So a lot of churning happens in the industries. Even within the industries, a lot of firms entry exit continuously. They start their operations, they find they are not profitable, they leave the market. That's what actually Melitz model say everything in a very succinct manner. We will see today. Even exporters versus non-exporters. Within an industry, only some firms export, many others do not. We'll see. Exporters are larger, more productive, pay higher wages. Exports are very concentrated in a few big exporters. Difficult markets are served by the best exporters. And multinational firms are the largest firms and more productive than domestic firms. We'll now see this US data set, percent of firms in these industries, and see the percent of firms that actually export. And this is pretty much, I've seen this with the Indian data, this is pretty much similar. Only, let's say, 12% of food manufacturing firms export. Only, I don't know, in paper, printing and related support, only 5% exports. The highest is 38, which is computer and electrical equipment. So overall, you take an average, only 18% firms export. You can see how small the percentage is. And that's actually why Melitz model people talk about so much, and because that's what it says. Why you assume the firms are heterogeneous and exporters are different. Some farms do differently because a large section of the output is governed by the small set of farms. Do you know the ratio in Indian case? In India, 20% of the farms drive 80% of the output. It's that unequal. Come again? Pareto actually says that. That's why Melitz model is so important. Because Pareto says 80-20. And we in the found data exactly like that. This is almost 80-20 ratio. Even and the opposite side, the 80% of the 80% of employment. 80% of the farms has 20% of the employment. So in the formal sector, what I mean is, the formal sector has the least employment, right? Here, because we have a large informal sector. So our employment, like 10%, 80% of our employment is within only 20% of the firms. 80%, the opposite, exactly opposite. This is very similar. This is very simple. So you can see total employment across all plants is about, so our exporter plant has 77%, 78% more employment than a non-export. That big the plant is. Shipments, the amount shipments they export or shipments they produce is about 105% more. So exporters inherently, you can see these numbers, average wage. So an exporter pays about 18% more wage than a non-exporter. So that big, if you're working in an exporting firm, you get much more paid. Or it's the same exporter premium with the US manufacturing. If you see log employment is very similar with industry fixed effects with shipments, with value added per worker. So you value add about 11% more in this case. In TFP is higher, wage is higher, so everything is high, more or less. This is 2002. And this is pretty much very similar. This is Germany data, this is France, United Kingdom, Italy, Hungary, Belgium. All of these have high employment premium, value added, wage, capital intensity, skill intensity, everything is very high. Even higher for the FDI makers. The firms which are actually multinationals, you can see the numbers. If you see for the employment, for let's say compare Germany, as a simple firm, which is an exporter versus non-exporter, there is a 3% or 300% exporter premium, and if it's exporter plus FDI, it's close to 1300%. Is that high? Is that difference? The multinationals are the biggest of the firms and pays much more wages and much bigger because they have multiple establishments. Between countries like UK and Belgium. Come again? The difference between UK and Belgium is very high. Very high. Yes, yes, that's true. Explain why. It's because I think it's very difficult to explain. I think it's because the UK exporting and non-exporting maybe not that very different in that respect. It could be possible. I don't really can't answer this. And why this difference? Maybe UK is more unequal rather than Belgium. That's why. But Belgium is the highest. You can see these are Belgium and Hungary has the highest. Germany, France, Italy are very similar. But Belgium is kind of an outlier in this case.
The standard deviation is also that big.
Standard deviation is also very big. Yes, yes. The standard deviation is also very big. The variability is very big in this case. The wage is not that. So that means you can see, given this, so see the difference. So wage premium is not that big. But the employment, that means it could be the average wage in Belgium is lower than the others. That can explain this. Otherwise, I don't see any other point to explain why UK and Belgium could be that different. You can see TFP distributions. For this is for EU data. You can see the exporters in the FDI have much higher log of productivity, much higher than exporters than domestic firms. So it's basically the big exporters, like multinationals, produces goods at a higher productivity, then the exporters, then the domestic firms. And this is in the log, there's a significant difference that means. And you can see the share of exporters in total manufacturing. In Germany, the top 10% of the exporters export 90% of the goods. It's that unique. It's only governed, the entire international trade scenario is dominated by only few players. Right? I had a graph, I should have put this recently. So there are only 12 companies in FMCG market, if you know what FMCG is. Yeah, so in the FMCG market, there are only 12 firms, only 12, which has more than 550 brands across the global market. So you can imagine how concentrated this can be. Right? This is small firms deal with small market share. Big firms, that's why firms are very, very different.
How it is like it's relevant to competition policy.
So yes, competition policy is very relevant in this case. So that's why the competition policy, competition commission we need to see is actually this is because of overall Darwinian process that the firms are naturally growing, some firms are naturally dying out, or this is due to some kind of collusion happening with some firms. If you know, I forgot the recent case in the Indian. So there are two firms which being fined severely by the Indian Competition Commission in the cement industry. Look up the Indian cement industry recently. I forgot the name of the two firms. They really signed agreements to collude and take a large, I guess, Lafarge and someone else. They almost took up huge set of the market, and then the Competition Commission came in and sued them. And this happened also in the US was the first one to show how this can be done. So Bell Laboratories is one of the biggest microelectronic firms in the 1970s, 80s. They started this pseudo monopoly. So what they used to do is they used to go to the small firms and buy out the small firms, creating a pseudo monopoly over the years. So the US, someone took a suo moto, filed a case in the US Supreme Court and broke Bell Laboratories into 9 different parts, because they are creating unhealthy competition in the market. Is that not the natural process of growing in the market? You are colluding with someone. This is unfair means of making small firms go out of the market. The natural process is fine, but this is not a natural process of, right? So competition commission is very important.
How to distinguish between economy of scale and collusion?
Oh, they can. I'm pretty much sure Competition Commission has economists who can distinguish between this. That you can write how things are evolving over the years. They look at a lot of trends. They look at your company histories. They look at your balance sheets to find out how this is actually economies of scale or this is collusion. I'm pretty much sure there are economists and they employ economists to observe this. You can see this is very skewed, exporter versus non, and very 2 years at 98 and 2003, and it's very similar. And the peak, you can see the concentration is in the top end of the distribution. So it's very skewed distribution. I am at 2, how much? Okay. It's very similar in terms of the skewness. This is French data in 2003. You can see, look at this number. I don't want you to look at this, all these numbers, look at this 76.3. So the 10 plus exporters selling 10 plus products are governing 75%. So 3/4 of the entire market is driven by this small set of firms. So that's skewed. And this is exporting and firm performance. There is strong evidence we are discussing is in favor of self-selection. We have more mixed evidence in learning by exporting, especially for developed countries. Developed countries, we find more self-selection effect. You can see this is learning by exporting. See, this is the switch here, where the firms are switching from being a non-exporter to non-exporter. Now see the switch plus 1. This is Germany. Look at Norway. This is value added per work. When you start as an exporter, learning by doing, you can see your productivity is increasing for Norway. So once you switch, this is learning by doing. Once you switch to being an exporter, you are learning from the market and your productivity is growing. So you can see why I put in this graph to have mixed evidence. In case of Germany, it switches, but it doesn't grow much. It remains the same. As for France, it also switches, it remains more or less the same. This is not significantly different. Apart from Norway, it's not significantly different. There is also evidence for Slovenia as well. So it's very mixed evidence. The learning by doing effect, when you switch to the export market, you do not grow much in terms of your productivity by switching to the export market. This is again premium that is a very simple regressions where you will have exporter versus non-exporter. We'll do and you're regressing on total employment, shipments, value added per worker, and you can see these are all very significantly highly different in terms of exporters versus non-exporters. This is the same thing when you are a starter. You can see when you're switching to the market in terms of productivity, average productivity, your productivity level goes up significantly, rather than any others which have quit the market or non-sequential in the market, something like this.
So this is event study kind of.
This is event study kind of graph. It's the same as an importer. Even if you're an importer, importers are few, bigger, more productive. I'll give you an example. You can see percentage of firms in export was 80 and imports is 40. And the firms that actually do both is 11%. Is that even less? So only 10% of firms actually import, export, and import. And they're driving everything. Right? The entire market, imported goods market, is driven by only 10% of the firms. And this is pretty similar across, again, it's pretty similar across different countries. Trading premia is again the same. Log of employment in exporter and importer is 175%. 175% more employment happens. They sell 31% more goods. The value added per worker is 25% more. They give 33% more wage. So all these are very, very big numbers. Trade liberalization and reallocation. So trade liberalization, what we see is that was we were discussing before a bit, it results in exit of low productive firms. And it's not only trade liberalization, we have seen with other industrial policy changes as well. Until and unless the policy is targeted towards upliftment of small firms. If a standard policy is taken, then you always see exit of low productive firms. If not, directed policies taken. There are some directed policies, sometimes taken by the industries to take out some firms out of some set of problems, then it's a different question altogether because it's a directed policy change. But when there is a natural shock comes in, a quasi-natural shock comes in, it always results in exit of low productive firms, changes in industry composition as high productive firms expand and enter the export markets. One of the seminal papers, if you have a chance, read by Nina Pavshnik. Nina Pavshnik found out that 19.3% productivity growth in Chilean manufacturing happened during the trade liberalization. And we found very similar events, very similar numbers for India during the 1990s trade reforms. We found also that there's a large productivity growth. 6.6% out of this came from exit productivity within plants, and 12.7% was reallocation of resources from less to more efficient firms. So basically, you can see the reallocation of resources is almost double of within plants reallocation. Within plants reallocation means now I realized with the trade liberalization that I am using few of my inputs very inefficiently. That's called the within plant. Then I'm changing my composition of resources. I am firing maybe some workers, I am recruiting some additional workers or new set of workers. I am not using that machine rather than other machines. So that's a within plant reallocation. Okay. There are margins of trade. We call it intensive and extensive margins. Intensive margins, extensive margin is basically, this is the intensive margin and this is the extensive margin. What we call by intensive and extensive, yes, just give me one. What we mean by extensive and intensive and extensive? Intensive is the volume of exports. And in extensive is the number of exports. One is the volume, one is the number. Yes.
Sir, I have a doubt on the previous slide.
Sure.
Sir, you have mentioned trade liberalization results in exit of low productivity firms and high productivity firms expand or enter the export market. So my doubt is like, was trade liberalization policy such that it has not resulted in increasing the productivity of small firms and keeping them in the market, or was it a deliberate action to like benefit the larger firms or let the smaller firms exit the market?
So see, trade liberalization happens. So most of the trade liberalization policies are not deliberate. What is a trade liberalization policy? Trade liberalization is simply what the governments do. The governments come and drop tariffs. That's it. And if you're a big firm, I'm a small firm, that means the drop of tariffs applies for two of us, both. If you are importing good, for example, at this low price, I can also import good at the low price. When there is a de-licensing policy, then it can be targeted towards certain set of parties like high and low. A trade liberalization is equal for everyone. For that industry, for example, let's say let the industry's tariffs is dropped down. For every firm in that industry, it applies the same. So it's again Darwinian. When trade liberalization happens, what happens is why for small firms die out because they cannot withstand the competition. Because now foreign firms can come and sell in your market. You cannot compete with the foreign firms; they die out. And overall, if you think of the consumer welfare, we gain in terms of consumer welfare. Equilibrium welfare you have to think about because there is an exit that happens. Some producers are losing out. There's a producer loss that is happening. So consumer loss is better than the producer loss. Then you have to think about whether the deliberate loss is actually gaining or not, positive or not. But as a consumer, we almost always gain because now we have more high quality, efficient products in the market produced by more efficient firms. Some firms which are not good products have died out in the market. That's a natural because they cannot withstand the competition in the market. Trade liberalization brings more competition in the market. Then it opens up the field for everyone. Delicensing is delicensing is a domestic industrial policy. It's not a trade liberalization policy. It's allowing every farms to operate more efficiently. So if you know the Indian policy, some products are not still being delicensed. That's a targeted policy. That these products are reserved for small and medium scale enterprises. You can look up this policy. So that big firms cannot produce those products so that if these firms die out, then there's a huge loss in the market in terms of producers, in terms of employment. In India, in other few other developing countries as well, some products are reserved for small and medium scale enterprises. That's an industrial policy which targets firms to kind of keep certain products for certain firms for certain products for certain firms. So that's kind of maintaining till the equality, some sort of equality in the market so that some set of small firms also produce. But trade liberalization in general comes as an external shock, more or less. That there's a demand. Indian trade liberalization was an external shock because India didn't have imports, foreign reserves for only 2 weeks or something like that. And then there was a stabilization package from IMF, and the stabilization package was pretty much in terms of dropping tariffs because India was at very, very high tariffs. Yes.
You said the policy are targeted for specifically for the medium and small enterprises.
That product is the policy.
The motive of that policy is to convert medium to large scale enterprises.
So yes, so that's a very debatable question. So yes and no, both. It depends. Why yes? Because you want more big firms in your market, absolutely. But there are why no? Because you have to understand whether they are producing firstly products efficiently or not. Then you let them grow in that market. The second one is the plants itself or the farms itself doesn't want to grow because they enjoy these benefits of the incentives in a small one. So that's another problem. Now you have to think about this. So there are two things. If let's say if you take out this cutoff, that if you are below this plant and equipment, then you're a small and medium scale enterprise, you're enjoying the incentive, right? There's a cutoff. Now lift that cutoff. Think about lift that cutoff. What happens? These firms would try and grow, but these firms might die out because of the competition. You don't know where this will go. Because you don't know where this will go, that the cutoff is still there. Because you have to because either they will die out, not face because they are restricted, they have not expanded by this cutoff much, so they don't know how to behave in the competition. For example, think about you are a sports player, you are doing state competition. Now you're restricted to state, you're a superstar in a state. I take you out in the national competition, and then you might be a champion, you might die out, be a last. So you just don't know. So that's why there's a cutoff. Because the government I think that Department of Industrial Policy. Or these, I mean, taking the example of India, this is very similar across other developing countries as well. They reserve certain sectors for certain set of norms.
They
They
also recognize the value of sales.
They also recognize the value of sales. Yeah. But the point being is, these reservations are crucial in certain sense because a lot of employment is driven by the small and medium scale enterprises. So you're not very sure that even if they lose employment, you're going to relocate them in other farms or not. So it's a very debatable, it's a very tricky situation.
That's why they also undermine the investment law.
They also, obviously, because you're not allowing farms to grow, that means you're undermining the investment. Some farms maybe have a lot of potential. You're not allowing them to grow, right? That's why, but if we are all farms that potential, we don't know. Is the set of farms more potent in that category below? Is the set of farms which have more potential higher than the farms which will die out higher? We don't know this ratio. It's very difficult to.
Can the policy will be designed such a way that those farms which are growing so much, like will not lose their incentive to grow?
So see, this is a prime example. This is a very good question. So if you look up, you should look up the industrial policies of South Korea. South Korea is a glowing example of how actually industrial policies interacted with trade policies should be taken. They opened up the market with government monitoring. That's the best way. If you can do this, because if you look back in the 70s and the 80s, South Korea and Argentina had almost exactly similar per capita income. Now see the difference. Argentina also opened up. Argentina, what Argentina did wrong was Argentina opened up a capital account. When you allow flights out of your capital account, things can go bust. Argentina is a growing example that if you come and use your internal capital by foreign firms, then it becomes very difficult. Then the capital market becomes volatile. And there could be a huge capital shock. They can randomly take out capital and go away. Then you don't have capital in the domestic market, right? But that's the problem, huge problem. And that happened. But South Korea opened up, but very carefully implemented this industrial trade policies with the government monitoring. Very tight, but private players play with the government monitoring. If you can do that, that's the best outcome. And South Korea has done this very, very nicely. Over the years, you can see South Korea's growth. And this is an example in the world of South Korea. And go back in the 1970s and see South Korea's per capita income. Recently, we are comparing the other one was Iran versus Poland. Go back in the 80s, see Iran and Poland almost has similar per capita income, and now see the gap in the difference. It's a completely different. Iran and Poland is more or less. It's not the trade liberalization process, but it's a political regime. It's a completely different set of arguments.
And Iran is an oil exporting country, so.
But it doesn't export oil to the major nations. Only China. Only. Because there are sanctions. So you cannot export to the bigger ones. Anyway, let's progress. Margins of trade. So you can see margins of trade, both distance, they are showing here is distance has a negative effect on value. Like when there's a large distance, you less exports. Even the farms, there is also effect on the extensive margin. Then less amount of farms also export in the larger distance. If you look up the farms which are only exporting to the US, we'll find only 3 or 4% of the farms exporting to the US. So that's what it is saying, that margins of trade affects both intensive margin as well as extensive margin. How much time? Almost there. Prices and quality. There's a large heterogeneity within industries across products, even within disaggregated categories. If you take within 10 DG products, you will also see there's a large heterogeneity. There is important price variation, which supports basically that vertical differentiation. Differences in terms of quality is very much in present. Like even within narrowly defined industries, firms produce products which are very different in quality. You can see, and on the farms, actually expose the high quality products to the higher nations. So this is per capita GDP countries, and this is shirts prices. So you can see the farms which are producing high quality products is in Japan, Belgium, Switzerland, Canada, in Denmark, Singapore, Norway. So these are high income nations, and the farms also export their high quality shirts or high price shirts in the high GDP nations. So that's how we behave. I sell my highest quality or the highest price product in the countries which are highest, because they have the means to buy. As simple as that. Exporter dynamics, there is importance of sunk cost in exporting. But are they dependent on activity, destination, or destination product specific? Like, what I mean is, are they dependent on the type of production that I do? Is it different across the sunk cost? Is difference across, I don't know, producing shirt versus shoes? Is it different across sending it to Belgium versus UK? Or this is sending it to destination products, sending a shirt to UK versus sending a shirt to Belgium? What are the sunk costs? The sunk costs are very important. And that's why exporters are small and only a few survive after a year. They start selling because there is a huge set of sunk cost. When you're selling in the foreign market, you have to consistently set up this work. You have to go to this called trade fairs. I'm pretty much sure you all have heard of this. To set up your shop. When doing it domestically is very different. When you're going to the international market, you have to set up fair shops, trade shops across different zones. And these involve a lot of cost, because you have to think of everything. You have to all take out this cost from your sale, from your price. That's about it. That means you have to there are two ways. Like economics has the very simple. Either you drop your production cost, you have to minimize, or you maximize your revenue. And it is not the minimizing your cost is easiest, but maximizing revenue is the toughest, because you need innovation there. How do you maximize your revenue? That's why you will see always the easiest, the farms or will cut down employment, they are dropping this, because that's the easiest thing. But maximizing revenue is very, very, very difficult. But when they survive, if they survive, they grow fast, they account for a substantial proportion of export growth. You can see here in 1996, there are about number of farms, about 10,000 exporters, and it drops down to about 2,000. This is for the US. It's that different. You can see in the market coverage, in terms of the market transition rates, there is no change in the year zero. 83% of the farms actually do not export, and then it goes down once the number markets increase. Very quickly, multi-product farms account for the bulk of the exports. There's a new margin of adjustment, which is the multi-product with a single product, and it seems to matter during the episode of trade liberalization. There's a glaring example. This is from India. Multi-product farms control 80% of the total output in India. You can imagine. And multi-product farms, share of farms are 47. So 47% control 80% of the product, 53% control 20% of the product. It's exactly parity distribution. Because that's why theory is very important. This is yes. So let's stop here in terms of the recent evidences, and then we come back to do a bit more about farm performance and Melitz and stuff. We have a break now, no? Thank you. I hope things are a little bit clear.
We're waiting for tea right now. About in half an hour. We'll start at 11:30. That will continue till 7.